Hey, I just wanted to quickly cover a really brief subject here: traditional bank loans versus an insurance policy loan. When I say the word loan, people have this immediate reaction, and it comes from their idea of understanding bank loans. So let me tell you the differences between the two. So, number one, when you apply for an insurance policy loan versus a traditional bank loan, I used to be in the mortgage business, so there's a lot of questions around what is the purpose of this loan for. We need to see documentation. We need to see more documentation. Credit is pulled, all these type of things. With an insurance policy loan, there is absolutely no documentation. There's no credit check, and there is no question about what the purpose of that loan is for. So that's just a very simple thing, not to mention that it takes, instead of 30, 45 days for some traditional bank loans, it takes maybe 2 to 3 days to get money deposited directly into your bank account. So those are a couple things, and it can be for any purpose whatsoever. So just keep those things in mind. Typically, it's just as easy as making a phone call to our office saying, "Hey, Joey, I need $10,000. Can you please wire it to my account?" I'll have you sign one page that says you're applying for this, and bang, it gets put in your account. So second big difference: when you go to repay a loan to a bank loan, they set the requirements, right? The term is dependent on what they're willing to give you at that time, what interest rate, all those type of things. Those things are not in your control. When you apply for a loan against your insurance policy, the insurance company does set an interest rate, but beyond that, they require no repayment. No repayment is required because they already have their collateral. That's the death benefit that they've agreed to pay you at that time. This is huge. So the flexibility in which you repay this loan is unfathomable. There's nothing like it. So you can have, as a realtor, builder, lender, you may have really good months, and you may want to put $3,000 as a repayment against a loan that month, and then you have another month where you really are scraping by and you don't have to pay anything to this loan. So that's a huge, huge difference. So there's super flexible on as it relates to that. The last thing I want to talk about is the emotional aspect, and that is when you have those great months we just mentioned, and you are killing it, and you have an extra $10,000 or $20,000 sitting in a bank account. You may, in the past, have not given that extra $10,000 to a car loan that you had $25,000 owed. Why? Because if I give up this $10,000 to pay this car loan, I still have a car note the next month. That doesn't go away. I may owe $10,000 less, but what if I have a bad month? I can't get that $10,000 back. Access, right? This is so huge. This is a constant theme with real estate professionals. If I don't have access to my money, that's not a great place to be. When you pay back a loan to your insurance policy, you have immediate access to get that money back if you need it. So you no longer have to wonder, should I hold back this extra money that I have? I can pound that loan back, repay that loan back, because I know I can get the money back. There is a huge, huge difference. When you're dealing with your money, the emotional aspect of money is so huge. When you pay back an insurance loan, that's what you get. So I hope this has been helpful. If you have more questions about this or other things, please text me, call me, or message me on Facebook, and we'll catch you next time.